Good morning, my dear students. Today you have joined with another webinar conducted by AAT Sri Lanka. Today our topic is elements and components of financial statements for our level 1 students in English medium. Today our lecturer is Mr. Isuru Manavadu. He holds a degree, he holds a PhD in accounting and economics, and also he's a chartered accountant by his profession. Not only that, Dr. Isuru is a lecturer at Department of Interdisciplinary Studies at University of Moratuwa. Over to you, Mr. Manavadu.
Thank you very much, Ms. Lilani. First of all, I would like to thank AAT Sri Lanka, management of AAT Sri Lanka, for giving this opportunity to share my experiences, my knowledge and insight with AAT students. Yes, I think now you can see my video, right? And I need to double check with the students. This slide is visible. Is this slide visible to you all? Yes, before starting the lecture. Yes, right. So I got message. Yes, this slide is visible. Okay, now I'm going to start the lecture. I have been given a limited time period, that's around 1 hour. The given topic is elements and components of financial statements. Before shifting into elements and components of financial statements, I would like to explain very important concept. What is that? That is accounting entity concept. Accounting entity concept. These are the things that I'm going to cover today: elements of financial statements and components of financial statements. Yes, now moving on to the accounting entity concept. What do you mean by accounting entity concept? Accounting entity concept is owner and the business are two separated entities. Owner and the business are two separated entities. When we do accounting, we need to think on business perspective, not the owner's perspective, right? That is the meaning of accounting entity concept. Accounting entity concept. Okay. So this, the understanding of this concept is essential in order to understand other concepts of accounting. This is the basic or important concept of accounting, accounting entity concept. Now, before moving into the main topic, I would like to start hypothetical business. Hypothetical business. We need to create a business today. Okay. Since we are doing this lecture with limited time period, I will create hypothetical business without getting answers from the students. I would start hypothetical business. Okay, now we need to start business. I would like to start manufacturing entity rather than buying and selling business. Manufacturing entity. Then we need to decide who is the owner of this business. I will be the owner, right? Isuru Manavadu is the owner. Okay, so I invest money in order to start a business. So can you please put a name for the business? Name for the business? We'll assume the name of the business is, let's say, Aralia. Aralia entity, right? So I'm the owner. So I invested, let's say, initial capital in the sense the resources which I invest with, resources which owner invested to the business, right? That is called capital in simple words. right? I invested 50,000 in order to start this business. Okay. So now I already told you name of the business is Aralia. Owner is Isurumanawadu. Now we are running a manufacturing entity. So what is the business? So what we are producing, we need to decide that one as well. What we are producing, let's say bakery products. We are producing bakery products. For an instance, buns, right? So you need to decide what are the raw materials which require in order to produce buns. We need flour, we need sugar, salt, right? Those are the kind of raw materials in order to manufacture buns, right? So based on that hypothetical situation, now we can, understand other parts of this discussion. Okay. Now, since now already we have started a business, hypothetical business, we have a responsibility, right? I'm the owner. Now, in this business, there are many stakeholders. In this business, there are many stakeholders. Can you please tell me who are the stakeholders of this business? First, I already told you, owner and the business are two separated entities. So, first stakeholder is the owner. Owner, right? Owner. Second one, employees. Employees. Then suppliers, financial institutes, government, general public at in general public, the students, researchers, so so those are the stakeholders of this particular business. Okay, stakeholders. So in accounting, what is the objective? Provide information to stakeholders of the business in order to take decisions, right? That is the objective of accounting. That is the objective of accounting, right? Please keep that in your mind. With that hypothetical situation, then it is easy to understand elements and components of financial statements. Okay, let me erase these things now. Okay. Now, I already told you, I already invested 50,000 money, cash, right? What is that? I already invested 50,000. What is that? I invested through cash. Cash is an asset. Cash is an asset for our business, right? So who has invested that? It has been invested by the owner. So I already told you, if owner invests resources, it is called capital. It is called capital. So asset, now you can understand, asset equals capital. Asset equals capital. Asset side 50,000, capital side 50,000, right? So what are the other examples for asset? What are the other examples for assets? Cash is one of assets. Cash. What else? Property, plant, and equipment. For an instance, buildings, motor vehicles, furniture, machineries. Then we can say debtors, and inventories. So those are the examples for assets, right? Those are the examples for asset. Already you know that. Okay. So asset equal capital. Asset equals capital, right? That combination is, I think you can understand. Okay. Here 50,000, 50,000. Based on the hypothetical example, 50,000. Here also 50,000. Okay. 50, 50. Now, I have a small question. Can we run the business with 50,000? Can we run the business with 50,000? You would say it's difficult to do, right? Difficult. Why? 50,000 is, uh, someone can say this is very small money, small amount of money, difficult to run the business, difficult to enhance the business. So what we can do, since this 50,000 is limited or not enough to run or enhance the business, what we can do? What we can do? So students can propose. We can obtain a loan. We can obtain a loan, right? We can obtain a loan. So can you propose a value? How much that we are going to obtain? Let's say we are going to obtain from government bank, for an instance, BOC, 500,000, right? In order to run the business smoothly, we need to obtain a loan from outside bank, right? Now, how this equation, that particular transaction affects into this equation, how? Our asset will increase because we are getting money, 500,000. Asset will increase. Now, what is the total asset of this business? We had 50,000, we are obtaining 500,000, so altogether 550,000. Capital remain unchanged. Capital remain unchanged, 50,000. Then you can understand. We have to add another part, another item. I would say item, right? After discussing this part, I would say the correct name of for these items. Okay, right. What is the other item or name? Asset equals capital plus liability. Capital plus liability. I already mentioned you 550,000 is we obtain a loan, 500,000, so capital remain unchanged, 50,000. Then you can understand in this side we need to fill the gap, 500,000. That is called a liability. That is called a liability. We have a current obligation. We have a current obligation, right? When we settle it, future economic benefits will go out of the entity. Okay, so that's called liability in simple terms. Right? Don't worry, I'll take you through on all the definitions of these items. Okay. Now, next section. Why, what is the purpose of starting this business? The purpose of starting business is making profit. Making profit. Okay. So profit belongs to whom? Profit belongs to whom? Profit belongs to the owner, right? The owner, because owner invested money. He has taken the risk of investment. So profit also can, the profit belongs to the owner in simple terms. Okay. Okay. Now we'll see the equation. Now you can see profit. You can see profit. So profit we wrote in this side, right? Right hand side, right? Profit already we have written in right hand side. What do you mean by profit? Profit means income minus expenses. Income minus expenses, right? Profit means income minus expenses. Okay. So instead of this profit, we can write asset equals capital plus within bracket income minus expenses plus liability. So this is the accounting equation. This is the accounting equation. Now here you can see five words, asset, capital, income, expense, and liability. There are five words, right? So already you know the examples for these words, right? You know what asset is. What are the examples of asset? You know what capital is, right? Then income. You know examples for income. What are the examples for income? For reminding purpose, yeah. What are the examples? You would say revenue, sales revenue, right? Then income received on rent income, dividend income, interest income. So those are the income. So in other than that, we can say discount received, discount received. Okay, that's also one of income examples for income. When it comes to expenses, what are the examples? Electricity expense, purchases, right? Then building rent, rates. So those are the examples of expenses. Liability already we have discussed, but I would like to mention few more examples of liability. Already we mentioned one example, that is, bank loan. Then creditors, we can say creditors. Those are the, one of a couple of examples for liability. Okay, now I'm going to discuss. I hope you understood this accounting equation. Through accounting the equation, I have shown you some letters, some words, right? So those words are called what? Those words are called what? Elements of financial statements. Those words are called elements of financial statements, right? Elements of financial statements. Okay, now you can understand. These are the elements of financial statement. I know personally some students, mix with elements statement and components of financial, right? Elements of finance. If we ask elements of financial statements, some students are giving answers as components of financial statement. That is completely wrong, right? You should specifically identify elements of financial statement. These are the elements of financial statement, but these elements need to be identified based on what? Can we say based on our wishes? These are the elements? No, we need to follow international literature. What is the international literature? As accountants, we cannot say these are the elements of financial statement based on our wishes, right? Everything documented. Okay, so IASB, because since AAT students are studying a professional courses, this knowledge is helpful, right? So IASB has issued a common document that is called Conceptual Framework. Conceptual Framework for financial reporting. Conceptual Framework, right? This is an international. This is, IASB stand for International Accounting Standard Board. International Accounting Standard Board. Okay, so that particular organization issued a document that is called Conceptual Framework. Conceptual Framework mention these items, these elements, right? These items as elements of financial statements. Elements of financial statements. Okay, asset, liability, equity. Now, in the accounting equation part, I mentioned as capital, right? Now you are thinking, what is equity? Equity means capital plus reserves. Capital plus reserves together. Let me explain that one from the previous equation. This one, capital plus profit, called equity, right? In simple terms. Yeah, when you learn step by step you will be able to understand more details on that, but in this is I think foundation level. So in this moment, so this knowledge is I think enough for understanding purpose about elements of financial statement. Okay, right. Now I was explaining the origin of these elements, right? Origin, all the definitions and the items, elements listed in the conceptual framework, right? We need to give the definitions for all the elements of financial statement by complying with the conceptual framework, right? Conceptual framework. Okay. Let me erase. Okay, now we'll see one by one the definitions of, before that, so I put a slide on conceptual framework. On conceptual framework is very important. IASB, initially issued a conceptual framework in 2010, and they have issued a new conceptual framework with revised definitions. In Sri Lankan context, in Sri Lankan context, CA Sri Lanka is issuing accounting standards for Sri Lankan economy, right? Okay, but those standards originally issued by IASB, right? IASB. Okay, so CA Sri Lanka has responsibility to issue accounting standard for the Sri Lankan context. So now in IASB has issued new document for conceptual framework in 2018, but we were using definitions for elements of financial statement, original document which issued in 2010, but now it has been changed. It is effective in Sri Lankan context 1st of January 2020. 1st of January 2020 onwards, this conceptual framework is effective. Okay. So I have mentioned definitions on 2 documents. You can see I have used 2 colors. I hope you can see, right? Now I'm going to show you, I'm going to explain the definition of asset. Okay. Now this definition we were using past, but it has been updated. Green color one is the new one based on the conceptual framework in 2018, right? So if someone asks what is asset, so you should give the answer this answer. What is that? But don't memorize the definitions. Try to understand the things inside the definition, right? Now let me explain the definition. I'm not going to touch this one. Because this is old one, right? Sometimes you have learned already. That's why I have mentioned 2 definitions in order to compare. Now you need to focus on this. Okay, green color one. Focus on green color one. Okay, now let me explain one by one in sense important sections, important items inside the definition. Okay, right. Now, a present economic resource controlled by, now we in earlier business we have invested 50,000 rupees, right? So that 50,000 rupees, that money controlled by whom? Controlled by the business, because that was invested by the owner to the business. So if those resources can be controlled by the entity, then we can identify them as assets. But there are some other features as well. There are other features by the entity. Entity mean early entity, earlier. Okay, based for an instance, as a result of past event, as a result of past event. So that asset occurred as a past event, right? For an instance, now you can understand. Simple definition. Asset means a present economic resource controlled by the entity as a result of past event. As a result of past event. Okay, that is the definition of asset. So now you can just look at the past definition. A resource controlled by the entity as a result of past event and from which future economic benefits are expected to flow to the entity. This is the previous one. But current one or new one, updated one is this. That is, shortened, simple, right? A present economic resource controlled by the entity as a result of past event. Very simple, right? For instance, what are the present economic resources? Economic resources means maybe cash, financial assets, property, plant and equipment, inventories. Those are economic resources, right? Okay, controlled by the entity as a result of past event. Okay, I hope you understood. Now let me explain this one. Right, economic resource is a right. What do you mean by that? What do you mean by that? Now I hope many of you all heard about leasing, right? In leasing, when we sign an agreement with leasing company, right? Suppose early entity need to purchase or acquire a motor vehicle through leasing agreement, So we are receiving the motor vehicle, but we don't have legal ownership. Right? Even though we are using the asset, even though we are using the motor vehicle, we don't have legal ownership. Through that particular agreement, we are receiving right to use the asset. We are receiving right to use the asset. Okay, so that right is one of our assets because that's economic resource. Because of right, we are using that asset. Because of that, we are getting economic benefits. Okay, and we control the asset. That particular asset is controlled by the entity. So since those features are complied, we can say those things are as assets. Okay? I hope you understood. Likewise, we'll discuss liability. Okay. Okay. Liability. That's very simple. Green color one based on new conceptual framework. Okay. See, present obligation. That word is important. We have obligation. We have obtained a loan. We have an obligation today because we have obligation to pay in future, right? We need to settle them. So we have obligation today, right? Of the entity to transfer an economic resource as a result of past event. That obligation is occurred as a past event. When we settle it, future economic benefits. So the word is economic resource. Economic resources are going to be transferred when we settle it, right? That is the meaning of a liability. Okay. I hope you understood up to liability. If you have any questions, you can ask, right? Audience, if you have any questions, you can ask questions, right? I'm free to answer. Okay. The same time, you can look at the previous definition. Present obligation of the entity arising from the past event. So those items common, right? Past event. Here also we have past event, right? Present obligation, present liability, future obligation, future liability. But in the old definition, the settlement of which the expected to result in outflow from the entity of resources embodying economic benefits. Right here, in the old definition, they are trying to explain by using many words, by using many words. Right? But here, transfer and economic resources. Simple, but same thing. More or less same thing explained in simple words, because they have used two words, economic resource. In the when we explain asset, also you saw these two words, economic resource, economic resource, right? Don't, again, I'm repeating the same thing. Don't memorize the definitions. Try to understand the importance of these words inside the definition. Okay, right. Now I'm going to explain. Now I'm going to explain equity, right? Before going to the definition, I would like to show small thing. You know, here, come to this slide. Now, I mentioned these two as equity. Right? These two as equity. Okay, capital plus profit, capital plus reserves. In simple terms, we can say capital plus reserves as equity. Okay. Now, if someone all assets and liabilities are given, right? Let's say asset 500,000, asset 500,000. So we'll take the same figure, 550, asset 550, asset 550, equals, you are not given equity. You are not given equity. Okay, you are not given equity. You are given here 100, let's say we'll take 500,000. Let's say liability 500,000. Liability 500,000, asset 550,000. Okay, asset 550, equity is not given, then liability 500,000. Now, how you are going to calculate equity? If someone asks how much equity is, what would be the answer? So very simple, huh? Very simple. The equity would be 50, right? Equity would be 50. 50,000. 50,000. Then two sides of equation equal. 550, this side also 550. So balancing figure. Balancing figure. Okay. Now, with please keep this point in your mind. Okay. Keep that point in your mind. Okay. Now we'll go to the definition. Yeah. So you can see two colors, green and red. Read two things. Both things can be read. A residual interest in the assets of the entity after deducting all its liabilities. All its liabilities. Red color one, the residual interest in the assets of the entity after deducting all its liability. Are there any changes? No. Remain unchanged. Previous document, 2010 Conceptual Framework, as well as 2018 Conceptual Framework, equity defined in concrete way, in similar way, no changes. So I hope you understood the definition. The residual interest, residual interest in the asset after deducting all its liabilities. Asset minus liability, you will be getting equity, right? So they use residual interest. Residual interest, the balancing figure, residual interest in the assets of after deducting its all liabilities, right? In the initially we said the resources that invested by the owner, right? That's a simple definition. But as per the conceptual framework, if someone asks, what is equity? You should answer based on the conceptual framework, based on the conceptual framework, right? You should say residual interest in the assets of the entity after deducting all its liabilities, right? That is the definition. Okay, right. Then we'll move to income. Income. Now, when we were discussing, hypothetical situation, I mentioned examples for income. Revenue, rent income, interest income, discount received. Those are the couple of examples that I have mentioned. Okay. Now we'll look at the definition. We'll look at the definition. Okay. Now tell me, equity. Now you know what equity is. Equity can be changed. Equity can be changed on two things. Can you please identify the two things? Equity can be changed on two things, basically. What are those two things? What is the first one? First one, equity can be changed if owner invests additional resources. If owner invests additional economic resource, or else the owner can withdraw resources from the entity as well. That is called drawings. That is called drawings. So in both ways, the equity can be changed. Equity can be changed. Okay. Equity can be changed. Right? So you please identify or understand that before understanding the income. Right? So equity can be changed based on two things. First one, owner's involvement, right? Owner's involvement. Owner can invest additional economic resources, or else owner can withdraw economic resources from the entity. Okay, because of that, in what you call equity can be changed. Now we'll understand what are the circumstances where equity can be increased. Equity can be increased because we are talking about income, right? Equity can be now we'll focus on the increase part, right? Equity increase. First one, if owner invest additional resources to the entity, right? You can understand definitely equity will increase if owner invest additional economic resources. Okay, you please understand that. Other than that, what are the circumstances? What are the reasons where equity is increasing? What are the circumstances where equity is increasing, but without involving the owner. Right? Now we need to eliminate owner's involvement because we know equity can be increased if economic resources are invested by the owner. Definitely equity will increase. But that relationship, that what you call transaction need to be eliminated. Other than that, what are the reasons for increase of equity? That is income, right? That is income. Okay, look at that. Increase in equity, very important. Increase in equity, right? Increase in equity, other than those relating to contributing to the relating to the contribution from the holders of equity. Holders of equity means the owners. Holders of equity means owners. Right now, I hope you understood those two parts. Right now, we should understand how we are going to increase equity. So it can be done on two ways. First one, increase of assets or else decrease in liabilities. Increase of assets or decrease in liabilities. Let me explain through example. Suppose we received revenue. We received sales revenue. Okay, we received sales revenue. For an instance, 500,000. What we are going to receive? What we are going to receive as sales? We are going to receive cash. Cash. Cash means what? Cash means asset, economic resource, right? Asset. Increase or decrease? Increase, right? Asset increase. Asset increase. Okay. That cash received because of income, right? Income. Okay. Day-to-day transaction. Asset increase. Because of that, you can understand if asset increase, on the other hand, equity will increase. That increase should be identified as an income. Okay. Let me explain decrease of liabilities. Suppose we have a creditor. Suppose we have a creditor amounting to rupees 50,000, let's say, creditor, right? Creditor. We have purchased raw materials from, let's say, Sumudu. Sumudu is one of creditors of Arali entity. Okay, Sumudu is one of creditors of Arali entity. Okay, I will explain through an account. Since you are still first level, creditor, we have purchased 50,000. Right? Purchase account debit, creditors account credit, Sumudu. Right? Okay. Now, suppose Sumudu need money. Now, Sumudu has given 30 days to settle the money. Sumudu creditor is a liability for our business. Liability for our business, right? Liability for our business. But Sumudu need money quickly. He or she cannot wait until given credit period, 30 days. He need money quickly. That means earlier than 30 days. Okay, what he or she, what Sumudu can do? Sumudu can give a discount, right? Discount. If we settle, if earlier settle this 50,000 within 10 days, let's say Sumudu can give 5,000 discount. 5,000 discount. Then if we accept that offer, how much Arali entity should pay to Sumudu? We should pay 45,000. Right? We should pay 45,000. Cash credit, creditor debit. Okay, understood. Now, what is this balance? 5,000 is 5,000. We need to debit this side because now we don't have a creditor, we don't have a liability. So what will happen to the liability? Liability increase or decrease? Liability increase or decrease? liability decreased by 5,000. So this 5,000 can be identified as what? An income. That income is called discount received. So discount received account should be credited 5,000. 5,000. Okay. So discount received account credit 5,000. Creditors account debit 5,000. So now you can check with the definition, right? Check with the definition. Decrease in liabilities. See, decrease in liabilities. Yes, we need to, because of that, our equity will increase. That increase should be identified as an income. This is income. Right? Don't memorize accounting. Accounting is very thinking subject, right? Thinking subject. So everything, anything we can think and identify or understand. Okay, don't memorize accounting. Accounting is very interesting subject. Okay, now I'm going to discuss last element that is expense. That is expense. Expense also, opposite of income, right? Opposite of income. Now I already told you equity can be changed on two reasons. First one, owner's involvement. Second one, income or expense. Income or expense. Now we'll focus on expense. Decrease of equity. First reason is if owner withdraw money from the business, equity will decrease. Right? Equity will decrease. Then, other than that, if there is no owner's involvement, what are the circumstances where equity decrease? Expense, right? Expense. See? Decrease in equity, other than those relating to the distributions to holders of equity claims. Very simple. What are the ways? Decrease in asset or increase in liabilities. Decrease in asset or increase in liabilities. For an instance, this one, decrease in asset. Let's say we paid electricity bill. What will happen to cash? When we pay, cash will decrease, asset will decrease, right? So because of that decrease, on the other hand, equity will decrease. But that decrease should be identified as what? An expense. That is called electricity expense, for an instance. Okay. On the other hand, suppose we have not paid electricity, even though we have used electricity for the particular month, particular period, we have not paid. Then we are doing accounting on accrual basis. We are doing accounting in accrual basis. So since we have used resources, we have used electricity, we need to account it. Even though we have not paid, we need to account it, right? Since we have used electricity, we have a current obligation on a particular date, right? We have a present obligation, right? When we settle it, future economic benefit, the economic resources will go out of the entity. That means economic resources will transfer. Payable, right? Can you hear me? I hope you can hear me, right? Payable, electricity payable. So what is that? Electricity payable is a liability, right? Electricity payable is a liability. So liability increase, right? If liability increases, on the other hand, we need to identify that one as expense, electricity expense. I hope you understood. I hope you understood. Now we'll move to last part of the lesson, last part of the discussion. That is components of financial statements. Components of financial statements. In order to mention, in order to explain components of financial statement, I would like to, mention the definition of accounting. Simple definition already I mentioned. Accounting is a process of collecting, recording, classifying, summarizing, analyzing, interpreting, and communicating those information to the stakeholders of the business in order to take decisions. I already mentioned this definition. So who are the stakeholders? Already mentioned in the beginning of the lesson. Owner, customers, government, suppliers, financial institutes, banks, overall general public. Okay, those are the stakeholders of the business. So there are a couple of, I hope you can you hear me? Yeah. In a business, there are a couple of 1,001 transactions per day in a business, right? Generally. So transaction and events need to be collected, and we need to record, classify, summarize, right? And we need to, that summarized information need to be communicated to the stakeholders through what? Through what? Through financial statements. Through financial statements. That is the output of accounting system. In a system, there are three components: input, process, and output. Right? So output would be the financial statements. So financial statements need to be prepared based on LKAS1, presentation of financial statement. This is one of accounting standard, right? In the, I think, first level, since still you are in first level, but I think this is important to know, right? You will use these standards in second level, third level, right? But even though you are in first level, you should know there are things like this, right? We cannot prepare financial statements based on our own wishes, right? We need to comply. Okay. So what are the components of financial statements? What are the components of financial statements? Okay, let me explain components of financial statements. Now already you know one concept, profit. What is the statement which we are going to use in order to calculate the profit of the business? That is profit and loss and other comprehensive income. Profit and loss and other comprehensive income. That is one of components of financial statements, right? Components of financial statements. Second one, statement of financial position, right? We need to show the status of the business. Okay, asset equals equity plus liability. Equity plus liability. That combination need to be shown in the statement of financial position. Third one, changes of equity. Statement of changes of equity. You know what equity is, right? Equity consists of share capital, reserves. So how those equities, components of equities are changing over the period. So we need to show, right? That is called changes of equity statement. Fourth one, cash flow statement. Cash flow statement. That is special than other four components of financial statement. You know, preparing based on cash basis. But other four components are preparing based on accrual basis. Accrual basis. Notes to the financial statement. Notes to the financial statement. Notes to the financial statement. Okay. Right. Now, before going to the components of financial statements, I would like to show you the objective of financial statements. You should know that. Objective of financial statement. Now you can see the objective of financial statement. What is the object? Why we are preparing financial statement? Right? This objective is not my one. I already told you, we cannot say our own things. We need to comply with the international accounting standards. We are using international accounting standards. This is LKS 1. As per LKS 1, this is the objective of financial statement. What is the objective? Provide information about, these are the components, right? Financial position. Financial position can be measured through the statement of financial position. Financial performance means profit and loss, right? Through the profit and loss and other comprehensive income, right? Financial performance and the cash flows. Cash flows. Those are the main three components, right? Other two are, supported components. Okay, because changes of equity statements, last figures would be mentioned in the statement of financial position, and the profit and the net last figure of profit for the period would be recorded in the changes of equity and the retained earnings, right? You will be able to understand, you will be able to learn in future, right? But keep these information with your mind. Okay. Financial performance, cash flows, to useful to wide range of users. Important, that is important. Wide range of users means who? Stakeholders of a business, right? Making economic decisions, right? For that, financial statement provide information about entities' asset, liability, equity, income, and expenses. Those are the elements of financial statement. You know the definitions and the I personally believe or strongly believe you understood the definitions of all elements of financial statement as per the conceptual framework, right? As per the conceptual framework. Okay. Now, asset, liability, and equity. Asset, liability, and equity need to be shown in the statement of financial position. The difference between income and expenses, that means we need to show income and expenses and take the difference of income and expenses, then that is called profit. Okay, should be shown in the profit and loss and other comprehensive income. Okay, that's how those elements are linked with the components of financial statement. You should understand the linkages with these things. Those are not separated topics. There are linkages. Okay, that is important to understand. Okay, right now the time is I have around 5 minutes. Okay. Right. So these are the components of financial statement. Already I mentioned statement of financial position, statement of profit or loss and other comprehensive income, statement of changes of equity, statement of cash flow, notes to the financial statements, right? So the notes meaning, some explanatory things, right? We cannot show everything on the face of statement of financial position as well as profit and loss and other comprehensive income. If we believe that more information is required to the stakeholders of the business, we can provide that additional information in the notes to the financial statement, right? You know the objective of financial statements, right? Objective is to provide information to the stakeholders. That's our objective, right? Okay. Moving on. So one by already I have mentioned what are the things that we include in the financial position statement. Simply we can say asset, equity and liability, statement of profit and loss, income and expenses need to be shown here. There are specific, we need to comply with the guidelines given by LKAS 1, right? LKAS 1, they have mentioned tentative format. Okay, so we can comply. There is no fast and hard rule in the format, but we need to comply with that. Okay, we need to comply with that when we prepare these statements. Changes of equity, I already told you. Statement of cash flows, this is very, very important. There is a specific standard for statement of cash flow, that is LKAS 7, LK7, right? So you can learn in future. LKS 11, very, very, very interesting, right? Very, very interesting standard. So you can learn in future. Okay, that is statement of cash flow, right? Then notes, I explained what is the purpose of notes. We can add some explanatory things in the face of financial statement. Yeah. Now we came to the end of the session. I explained mainly two things: elements of financial statements and components of financial statements. Okay, now you know the differences between elements and components, and you know the linkages with elements and components, right? Okay, if you understood clearly, you are not going to mix those two words. Okay, elements, asset, liability, income, asset, liability, equity, income and expenses. Elements. Components, statement of profit and loss and other comprehensive income. Second one, statement of financial position. Third one, statement of changes of equity, cash flow statement, and last one, notes to the financial statement. Thank you very much. If you have any questions, you can ask.
Thank you very much, Dr. Manamadu. Actual students, you would have known clearly the difference between elements and components of financial statements. So we will have another sessions continuously for our AAT students. Tomorrow, as the Vesak Poya Day, we won't have any programs. So thereafter, we will continuously have programs. Thank you so much. Thank you, Dr. Manamadu.
Thank you very much. Okay.